Hello everyone and welcome to the True Potential Do More With Your Money podcast. This is episode 71 and today we're talking about the pound in your portfolio with the very people who manage the money in your portfolio. It is Paul Durrance, we're joined by George Bell and Jeff Casson as well. Morning everybody, how are we?
Peter, very well.
Enjoying the lovely northeast weather that we're having at the moment?
It's glorious. It's a big change for what we normally have in the northeast, but it makes it a lot more pleasurable.
Well, long may it continue. And today we're going to be getting into a bit more detail around the markets, and we're going to have a little look back on May as well. We've got a full month under our belt now, so we'll talk about more of that today. I think it's really important for our viewers and our listeners on the podcast that we explain a bit more about the psychology and the work that goes on here. So it's great to be joined by all three of you. We can get into some of that discussion today. But maybe, first of all, do we want to maybe have a little talk around the month of May? We've got, as I say, that full month under our belt now. We can talk about what happened in the markets through the month. So maybe, Paul, do you want to tell us how May ended up?
Yeah, it was a very good month. Global equities are up 1.6%. I think investors are really buoyed by the encouraging and improving or resilient economic data that we're seeing, not only within the US, but we're now seeing that broaden out. So we're seeing it in the UK, within Europe and other regions. So I think the standout equity market was Europe, up 3.2% in local terms. So that was very, very good. A position that we've been favouring within growth aligned actually. But Europe's been doing well because they've finally been able to get some momentum behind the vaccines. And you've seen some really positive economic data out from some of those southern countries that have been hit hardest over the last 12 months. The likes of Italy, the likes of Spain. So you've seen strong PMI numbers, you've seen strong retail sales in parts, and that's feeding through into consumer confidence. And so Europe's been the standout equity region. But other cyclical regions, the likes of Japan, they've done well. They've kick-started their vaccination program after being one of the later countries to approve vaccinations. Here in the UK was up 1.1%. Again, a cyclical region, high exposure to energy. Energy's done very well over the month. Commodity markets, materials have done exceptionally well. In the US, we've seen an interesting dynamic this year where we've seen a bit of flip-flopping between value and growth. This month in May, value's done better, so you've seen energy do well. And so the S&P 500 has perhaps lagged some of the other developed regions. In emerging markets, they were pretty strong as well, at 1.2%, so good in general for equity markets. In bond markets, investors have been favouring riskier debt, so high yields done well. Emerging market debt in local currency terms has done well, where you've seen strength in EM currencies such as the Brazilian real, the Mexican peso, and you've seen some US dollar weakness, which is always supportive of that asset. I think what's interesting is that you've seen inflation expectations pick up during the month. Right. So you've seen some assets such as global inflation-linked bonds do very well. You've seen gold also do particularly well over the month, up 7.6%, which is an exceptional month, and it's a very volatile asset. And perhaps we'll come on to discuss gold in how that compares with something like Bitcoin later on. But in general, very strong month.
Seems like it was a strong month pretty much across the board. And you mentioned that the vaccines quite a lot there and vaccination rollouts. Welcome Siri to join the podcast as well. So I guess that's a first for the True Potential podcast and probably a first for Siri as well, but that's great. In terms of vaccinations, obviously we saw a pickup in the UK in May, and there was I think there was a bit of a lull in April while we got stocks replenished and stuff, but May it picked up, and I was reading that in the EU, as you were alluding to they're starting to really begin to roll theirs out now as well. So is it too simple to say that it's all because of the vaccine? Is that why markets and confidence is really picking up? Is it just due to that?
I think it's a large part in due to that is because people are getting confidence to go out and do things.
Yeah.
And it's allowing, so what we've seen is we've really seen last year strength in the manufacturing side because that was able to work its way through the challenges of COVID-19. But as we've moved through that, we've really needed to see the services side of economy starting to reopen, and certainly as vaccines have been rolled out, there is a strong correlation with service industries then being able to reopen, and that in and of itself is certainly helping not just the UK economy, but economies, as Paul's alluded to, across Europe, and also the very strong performance that we've seen from the US as well on the services side. So it really is very much, I think, tied into that.
Yeah.
It's confidence. People want to go out.
And does
want
that,
to spend.
following on from that then, if we look at going into June and July, obviously there's now a real ramping up of second doses and more people getting the first, and obviously now I think it's just open to all adults in the UK.
Yeah.
Obviously then you've got to think about what's happening in America and Europe. But I mean, if the vaccination is if you like speeding up, or we're getting around more people, do you see that the market still this confidence that Jeff and Paul have talked about, is that going to continue, do you think, George?
Yeah, well, you normally have the markets leading the economy by anywhere between 3 to 12 months. We've been in quite an unusual period where you've had vaccinations kicking in, but a huge amount of central bank support and government support, which has really turbocharged a lot of that sort of forward-looking expectation. Where you are seeing it is exactly where Paul mentioned, the more economically sensitive areas of the market. We saw China come out of the pandemic first. We saw the US follow suit. Now what we're seeing is the more the areas which were perhaps lagging behind, such as Europe, starting to catch up in terms of the market performance there. Putting a document out today, just in the weekly roundup, just around the OECD expectations, and vaccination was a huge part of what they were talking about. They've revised their economic growth expectations up, but what you're still seeing is that differential between the developed world and the developing world, and the need for global cooperation in order to get more vaccinations to the developing world, in order for them to cooperate fully in that recovery. They will benefit somewhat from the rest of the world coming back online, trade picking up, manufacturing picking up, but for global coordination we do need to resolve the issue of the lower vaccination rates.
And I think it's an interesting point that to think about, because ultimately a large part of the emerging market landscape plays into that commodity strength that Paul's alluded to, so that's a positive for those economies. But really then to get their domestic economies back working, they need the vaccines in the same way as developed markets have seen. So I think that it's a challenge for, I suppose, society to think about over the next number of months, how actually we do get sufficient vaccines to the emerging world, such that they can then see the similar benefits that we've seen of a recovery in our services side of things, and domestic consumption coming through, because ultimately that's what's required to bring some self-sustaining momentum into those countries. Yes, they can benefit a lot from international recovery, but really you want the domestic economy to be starting to kick on as well.
Sure.
And just to maybe just expand on one thing that George said there as well, just in terms of that central bank support, quite an interesting development this week has been just the Fed stepping back from their corporate bond purchases. So if we cast our minds back to March of last year, the Fed stepped into the corporate bond market when they thought it wasn't functioning effectively. And so they stepped in and they bought corporate bonds, and what we've heard from them this week is that they're going to stop that, and actually they will be selling those bonds back into the market. So I think that's an encouraging sign that they see that actually there's health in that corporate bond market. We'll have to see how the corporate bond market reacts to the supply that's going to come as a result of that. But really it does show how Fed stepping in stabilised the market, allowed that market to evolve. Last year we saw great issuance into the corporate bond market, and now stepping back as we're seeing that recovery coming through.
I think it's just returning back to normal, which can only be a good thing.
But it's one of the reasons we talk a lot on Modern Markets as an example about central bank statements, central bank reports, the minutes, what we're seeing from that, because it's all about the data, the guidance we're getting, but also the language which is used, where people really get a feel for, okay, what's going to happen within the bond markets, because that has an impact on a lot of other areas. It impacts the way in which you value equities. So it's an important aspect of consideration, and one which has been supportive. And just looking at the comments which were coming out from central banks in April and in May, that support continues to be there, but in areas which are perhaps becoming a little bit more targeted after you've had that initial surge, as Jeff mentioned. If they do see the corporate bond sector as an area which can start to survive on its own feet, it can still operate as an efficient market, then they can start to taper back their intervention there.
Good. And a good plug for Morning Markets there. Well done, George. You're a podcast pro.
I've got two in there. We've got the weekly article in there as well.
I'll stick with you because I wanted to talk about how some of that's fed into the portfolio performance. I've said at the top of the podcast that it's about the pound in the portfolio, and I suppose for our viewers and listeners, it really is. How does all of that take shape in their portfolio? So how have they done?
Yeah, I mean, it's a great point, Peter. I mean, we do talk a lot about single asset classes. What can we sort of digest from Paul's points there? You know, equities outperforming bonds in general over the month. You've seen the more economically sensitive areas which are outperforming. You've seen within equities a huge amount of dispersion actually between those such as, you know, tech, which was actually negative. You had the Nasdaq, which was down compared to areas such as, you know, as staples, the areas which are perhaps more value driven, as to the point which Paul made there. What does it mean for multi-asset investments? If we look at the portfolios, for the balance state as an example, after portfolio charges, that was up 76 basis points or 0.76%. You had the aggressive portfolio, which was up 0.81%. So we're generating a positive return there, strong return. But, you know, as you would expect, when you've got dispersion in markets, we see dispersion within the managers. That's exactly what we understand. We know that. That's why we bring about a diversified investment solution. And we'll take the view as to which managers we feel are best suited to the longer term themes. 1 month, you know, a month where we had positive returns, but it's a very short term period. What are those longer term themes that we're seeing coming through? And it's really just looking in terms of the economic landscape, seeing that recovery driven by vaccination, by central bank policy, looking at the areas of opportunity. I mentioned markets typically lead in economies by 3 to 12 months. We've seen some fantastic gains in areas such as the US. So when we get under the bonnet and work with active managers, which we are within the portfolios, where are those opportunities? And our view on inflation, which, you know, we are seeing increases in supply costs, but a lot of that is driven by bottlenecks in terms of demand is massively outstripping supply at this point in time. And we've talked about semiconductors, we've talked about raw materials, and we've seen a lot of evidence of this within the PMI data, which we've talked a lot about on Modern Markets again this week. But if we think about how are we positioned around that, I think we are positioned well within the portfolios in the sense that we are emphasising that view around the more value areas of the market, but we keep that balance because those risks of vaccination challenges in terms of central bank policy misstep, they haven't gone away. So we bring about what we call a diversified investment solution for clients. But if I look at the returns in general, one of our largest holdings within the balanced portfolio is UBS, around 17% of that exposure. They've been well positioned to capture this type of environment which we've been in. So that's been the key sort of drivers. I think we're positioned very well within the portfolios for that. But in terms of, you know, changes which our investors will have seen over the month, we made a change within the cautious portfolio. We increased exposure to a manager who uses more active equity management within that space. Why? Because when you are seeing dispersion, it really pays to have that active exposure within there, so you can really get under the bonnet, not just follow the index, look at where the opportunities are. We see regular inflows coming into portfolios, get that money to work and get it invested. That doesn't mean to say the portfolio stood still over the month. Paul mentioned a great example of a trade which Paul and the team in Growth Aligned are doing in terms of expressing that view on European value. You are accessing those higher yield opportunities within the Asian high yield market, within the US high yield market, within Allianz. That was another example of a manager who's been active, a new position gone on there in terms of US materials from some of the larger cap US parts of the market. They're active in the bond space. We talk about bond yields which have been creeping up slightly. How can you access a better return within a sovereign bond market? By pairing up different parts of the period, the term premium. You can look at different yields in different countries. So they've been active there. They took profits on a recent position. That money went straight back into another allocation which they see actually on the Australian government bond yield. We saw an increase in the copper exposure through one of our managers, so really playing into that theme of increased infrastructure spending in the US. So as you see China start to mature in terms of the recovery, as they start to taper back some of their lending within the infrastructure sector, you're seeing the potential for the US to come online there. So active, keeping that money to work, haven't stood still, seeing opportunities. If you're an active manager, there can be some great examples of opportunities out there, and we're well positioned to capture.
I think that's the important point, that it's the active management within the portfolios and what's actually going on below the hood, if you will, when the fund managers are active within them. And really, you can think about, yes, equity markets have had very strong headline returns, but within that, there's been a lot of dispersion, and it is creating opportunity. And I think, as George has rightly pointed out there, there's a lot of activity going on with our managers being very selective and very specific. The example that Paul mentioned around European value, you can now access that very specifically through an ETF, which is tracking those types of stocks. So you can get that exposure very quickly and at a relatively low cost within the portfolio. And that's the opportunity that is created by active management. Dispersion is good for active management. We've heard of, over the past number of years, active managers have certainly struggled in certain areas of the market. When you look at some of the data over the course of the year to date, active management certainly within equity is doing very well, because they're able to access some of those value opportunities that have been exposed by the recovery coming through. So those areas of the market that just have been left behind over the past number of years. We think about energy, we think about materials, we think about the strength that we're seeing in commodities. That's really playing out into areas of the market that people haven't wanted to invest in, but have now an opportunity has been created for them to exploit within portfolios. And certainly we're seeing that with our managers.
And is that the secret of your success then? Because you've got all these managers and all the data that comes into you, and of course that's what we mean by advanced diversification, right? So we're talking to all these managers, you've got the options, and then the active management aspect that you guys do of that as well. That's what delivers the returns that you're talking about. But when we talk about advanced diversification, Paul, advisors and clients, it's just that level of expertise. I always find it fascinating that that's what you guys are really plugged into, and that delivers the results.
Oh, definitely. And I think what's great about the team here is that we are having regular conversations about the information that we're receiving, whether it's through Bloomberg or through speaking with managers that we our strategy partners, or external managers that we perhaps may not be invested in. And it's regular meeting, discussing views and trying to distill what are those key themes, monitoring those key themes. And there's slight nuances that we really have to try and pick up on, and there where the opportunities are.
It's great because we do have regular meetings with the managers, and they tend to run in order. We'll sit down with one and then move on to the next, and each time you have a call, each time you have a meeting with the managers, you build up a bigger picture in terms of what they're researching and what they're seeing. So it becomes a more challenging discussion for the manager who's last. He gets everything thrown at him, but it's because we've been through this huge research process. We're not just getting one source of data here, we're getting 9 different sources of research internally as well as externally, as Paul said, and we're using that not to just take their word for it, we're using it to challenge each of the managers, so we can really, as Paul said there, distill that down into what's important and how we're going to act.
And do you always keep the same manager last, George, or do you mix it up a little bit?
We do change it up. I'd try to, but I
think the other thing, just to really build on that, is that we actually, because there are funds, we actually see the action coming through at individual manager level. So actually, one of the interesting thing, having been on the other side of the fence, you can really talk about a really strong narrative that a fund manager will talk to, and they'll say, they'll talk about the backdrop, how they're making changes or thinking about making changes in a portfolio. Sometimes it doesn't come through, but actually we sit and we look at it each day to see, well, are they enacting any of those positions that they discussed and that fed into the positive or negative narrative that they had. And that's a very powerful thing, to be able to see it being actioned or not. And then, as George has alluded to, it gives us that challenge.
It's a great point, Jeff. I mean, from an advisor's point of view, often what you're trying to do, from the advisors I talk to and the information I hear from them, is you're trying to get your clients to understand that money sitting in the bank in cash is never going to generate any real growth. And in persuading people to think about an investment and to think about a long-term goal alongside that. And then to know that pound or that £50 impulse save or whatever that might be, that this kind of expertise is going on behind the scenes and looking after that money and looking for opportunities, is the bit that perhaps the advisors and clients never see, but it's just so reassuring to know that it's going on.
And it just happens all the time. It's what actually really drives us as a team. It's to deliver those returns for the end client, because actually at the end of the day, it's their savings goal that's most important, and that's what we're there to help them achieve, to get a return that is going to allow them to beat inflation. As you say, leaving money in the bank is not going to earn that sort of return that people need.
Well, you mentioned inflation there, and I think, Paul, you mentioned it in your piece at the start as well. It's, if you were looking at, I mean, Twitter's never a great place to take a general view of things, but if you look at, Bitcoin continues to be all over the internet and Twitter, and inflation is obviously still a talking point. We've talked about it probably every week on the podcast for the last 3 or 4 weeks, but it's very much still a key consideration, isn't it?
Certainly, it's very much a real view within markets, and a consideration for all of us when we're thinking about it. And really, Paul made the comment at the start that we've continued to see commodity prices increase, and that certainly is feeding into this backdrop of challenges that we're seeing from rising input costs. And over the past week, and indeed very similar to last month, the PMI numbers, the Purchasing Managers Indices, when you break that down below the headline number that we all focus on, and we look at and we see how prices paid component of that that continues to actually increase. So there is a real inflationary push coming into manufacturing industry, definitely.
Just explain PMI for people who perhaps don't know what that means and what the significance of it.
So what they are, they're monthly surveys that are taking on both the services industries and in the manufacturing industries. There's various different components within them in terms of employment, prices paid, inventory levels, etc. That builds up to bring you an aggregate number. That aggregate number, if it's above 50, that means it's an expansionary territory, below 50, contractionary. And what we've seen over the past 14 months is really a massive increase in PMI numbers to levels that I haven't seen in my career, which is quite impressive. So where they are at the moment, and actually even looking at what we saw in the US this week, they moved higher again, which was kind of unexpected. And those PMIs, survey-based data that allows you to get a sense of how manufacturing services are really thinking about their operating environment. So for them, the operating environment is good because they're in expansionary territory and it continues to improve. Components of it that are challenging are the prices paid, and really quite interestingly on the employment side as well, and challenges of getting labour, which is quite an ironic thing to sort of say at this point in time, given where we know unemployment rates are. But there's a number of nuances in that, particularly in the US. We've talked a lot on these podcasts and morning markets around the support that's went into the US labour market. At some level, some commentators are suggesting that that's stopping people coming into the labour market because it's more attractive for them to not enter the labour market given the support they've had. So there is two areas potentially to think about going forward, that of commodity push inflation coming through. We've also got potentially that maybe in hospitality, for example, that we'll have to see businesses increase wage rates to attract people back into those industries. And that's not just a US phenomenon, it's something that's very evident here in the UK. There was a KPMG survey that came out yesterday overnight that really talks about the challenge that hospitality itself is facing and the potential that they will need to push wages to bring people in to those. So inflation is there. Paul also referenced gold. Gold, typically your inflation hedge that people use within portfolios, had a great month last month. So really that concern on inflation hasn't gone away, and I don't think we're closer to answering the question, is it something that's just going to be that word transitory that we hear all of the central bankers talk about, or is it something that's slightly more longer term that we have to deal with? The jury's still out on that one. You mentioned Bitcoin as well. People maybe have suggested Bitcoin could be a good inflation hedge. Certainly, with inflation moving up over the past month, it hasn't worked in that way. It's falling, some 43% in the course of May. So not a great inflation hedge.
Well, maybe for 5 minutes, and then a different story for another 5 minutes, and who knows what after that again. So
yeah, it's a challenging but a very volatile ride over the course of this month.
It's interesting over the month that you saw Bitcoin actually fall off, but then gold at the same time rallied, and you saw perhaps institutional investors think.
And why did that happen, Paul? Why did Bitcoin, to use your phrase, fall off?
I don't follow.
As if there's one single reason. I would imagine.
I think it's clearly Bitcoin, the price got to an extremely high level in a very short period of time, and people become nervous a little bit about where it could go and whether it's a bubble territory and it's just so volatile.
I think to reference something you said earlier, Twitter.
Yeah.
Right.
And the use of that by certain individuals seems to have the ability, much as 18 months ago we were talking about the ability of a certain president when he tweeted things to move the market quite significantly. There's Elon Musk when he seems to tweet around what's happening with Bitcoin or his views on cryptocurrency. It does seem to have an outsized impact on the price.
I suppose you also had the Chinese come out and talk about the mining of Bitcoin and just how much energy is required to do that, and it's just not really good practice.
It's also, the PBOCs, the People's Bank of China, are sort of working towards their own digital currency mechanism, which will give them more transparency over transactions than what they're currently getting within Bitcoin. So putting a lot of sort of constraints around corporations and their usage around existing digital currencies. So you had that, you had the tweets which we discussed last time we were on. We talk quite a bit about fundamentals of markets and valuation of stocks, valuations of bonds. A big driver of investment markets is also behavioural finance and herd immunity. There is definitely herd immunity behind Bitcoin, which is the momentum which is gathered from social media platforms. We were just talking at the desk before we came in about it's been clearly a very volatile month for Bitcoin, and in the trade press, in a lot of the reports which we see, Bitcoin isn't a huge factor of the conversation. It is definitely there. It's something we're very aware of and discuss on a regular basis. But it appears in more social media type platforms and channels.
Well, let's stop talking about Bitcoin before we move the price ourselves anymore. I want to talk about the UK because I was reading in the week that there's a lot of confidence around the UK and where we're heading as a country and all the rest of it. But actually, if anything, perhaps not enough confidence. And do you see that, Paul? Do you see that the UK is, in terms of investment into the UK and just the UK economy?
I think that things have shifted for the UK, and there is certainly a lot more positivity when we're speaking to our managers. People are allocating more to the UK, and we've seen the UK do well over the months. I think what's positive is clearly the vaccination programme has been a success, and we're now reopening, pubs are opening, restaurants are opening, but confidence is coming through. Consumer confidence has been accelerating quite materially, and therefore people are willing to go out and spend, and you're seeing that in the latest retail figures over the month, up 9.2%, twice as much as what was forecasted, and therefore businesses are looking to match demand by hiring more staff. And to what Jeff was mentioning earlier, is that they're struggling really to find the right staff. People over the past 12 months who have been unfortunate, been made redundant or made furloughed, have looked to perhaps retrain and take a different avenue or a different career path. So therefore they're having to push up wages, which we're seeing some tentative signs of higher wages come through. Looking at the figures, it's still pretty much too early to draw firm conclusions on that. But if people are going back into the workforce, higher wages are coming through, confidence is high, they're more likely to continue to spend not only on products but also services. And so we expect that to be maintained going forward. And I think what's interesting is that you've seen the strength of the pound. So the improvement in sentiment is helping the pound, and that's strengthened against the US dollar. Japanese yen materially year to date up 10% against the Japanese yen, but also against the euro. So I think it's something has changed for the UK, and I think just in our general conversations there's certainly a more positive spin, which is good news.
George, was there any sort of negative or setback this week? Obviously, there's a bit of debate around whether we're going to have this full unlocking on the 21st of June, or whether it's maybe going to get delayed a little bit. Did that have any effect on sentiment on markets?
It always has anything to do with the reopening of economies, because it's such an important aspect of getting service industries back online. It's always going to have a bearing in terms of people's thinking. So anytime, we saw that huge rush of momentum when you had vaccinations improving, and then whenever you get a delay or setback, the market does take that adversely. Now, what we are seeing is a program which is continuing at pace. So you're over, 60% of the UK population have received at least one dose of the vaccine at this point in time. So, it does have a bearing on people's thinking at this point in time. It can be seen to be putting a bit of wind in the sails, the way in which the programme's going.
Sure, good. I wanted to ask about if there is greater, if you like, confidence and appetite for investing in the UK. Does that would you see that, Jeff, as manifesting itself in the FTSE 100 or the more domestic 250, or is it just across the board?
I think it's probably across the board,
right,
for two reasons. One, that if we look at the structure of the large cap, the FTSE 100, as you mentioned, that's very much tied into global economic recovery. So we do have a large weighting within that index to the likes of energy, to the commodities, so metals and mining names, but also to financials. So in totality, if we're seeing a better economic environment globally, one would expect the FTSE 100 to benefit from that. Now, the one sort of swing and roundabout from that is because it's much more tied to the global economy, the strength of sterling is a negative for the earnings environment for those companies when you translate it back. Thinking then about that broader, the FTSE 250 is very much more exposed to the domestic economy, and that's an area that should in all likelihood be benefiting from that, and we've certainly seen that coming through over the past number of months. I think the other 2 points maybe to add around just the UK is thinking about what international investors are doing. So one of the things that when we get to the end of this month, and when we look at international portfolio flows, it'd be very interesting to see if we've seen international allocators maybe allocating a little bit more to the UK, and that's certainly coming in terms of fund flow. So that would be one data point that certainly is definitely worth looking at over the coming months to see that's coming through. And then you've also got corporate activity. So we've seen a lot of corporate activity within the UK market with both private equity and international companies coming in and acquiring UK assets. So a real indication that there is undervaluation there that companies are seeing. They're trying to exploit something that could be accelerated as we see the ongoing recovery of the UK at a discount to other areas in which we can invest.
Yeah, and we've talked about jobs, and the impact of that, not just on this podcast, but on recent podcasts as well. There were some jobs reports out, I think, in May as well, which also looked, very favourable and very positive. And that's part of your thinking as well, Paul?
Oh yeah, that's just one key element that's playing into a very big picture, and we're seeing encouraging data coming through in the US and the UK. We had some data out yesterday where the initial jobless claims, so those people in the US claiming for unemployment benefits, actually fell below 400,000 for the first time. So things are getting back to normal, and therefore, if unemployment's coming down, people are thinking about, and there's hiring difficulties, people are thinking about higher wages as well. So some interesting dynamics.
I think that's an interesting point, and today's an important day in terms of the US jobs print for May, but in terms of as we lead up to that, that's a great example of sort of evidence which we're seeing in terms of the US labour market and the health of that. So you saw initial claims, which is people going to claim support for the first time, as Paul said, coming in at around 385,000, so below that 400,000 mark. But in terms of, is this a one-off or is it part of a longer term trend? If you look at the 4-week moving average there, you can see that that's actually coming in some 30,000 lower on a 4-week moving basis. But that headlines do focus quite a bit on initial claims. Now, you've still got around 15 million people in the US currently claiming some sort of unemployment support or unemployment support top-up, some sort of additional benefit. Now, that's still a very high number, so it demonstrates that support is still needed, but it's still demonstrating a positive direction of travel. That number is around half what it was this time last year. So in terms of, what does that mean? It means, well, if we do see the employment reports coming out today, which are better than anticipated, then what does that mean for central bankers and their targets around full unemployment, or full employment I should say, and inflation? And does this mean we're moving closer towards those goals? And then how will that factor into central banks thinking around their need for intervention? Or does it disappoint and acknowledge the fact that central banks need to remain supportive as they are?
It's certainly going to be an interesting day, because the employment report for last month, when it came out in the US, was so far off beam in terms of the expectations that economists had for the jobs that were going to be added versus what ended up, I think, was it 200,000 or something were added, and expectations were for 1 million. So we're well off beam there. So let's see what we get today. We had the ADP report yesterday, which historically used to be a very good indicator of what the actual trend would be from the Bureau of Labour, and it suggested that I think around 960,000 jobs have been added in the month of May. So if we get a similar report to that from the Bureau of Labour today, it should be a positive from that economic recovery. But as George mentions there, the key point in it is really the participation rate. Are more people coming back into the labour force? That's what we need to see.
And just finally, is that the main thing you'll be looking for this month, like in June, looking ahead to the next few weeks? Is that what's square in front of you, or what else are you looking out for?
I think it's important to see it today, because it will certainly really feed into sentiment. It'll feed into sentiment around inflation. It'll probably feed into how the bond market reacts to it, and by virtue of that, what happens in equity markets. So we'll certainly look for that today, but it's only one number. And as we said, the economists have been very wrong in quite a few of these numbers over the past number of months. So we'll not focus too much on it, but it is a good indicator for us to look at. But like everything, as we talked about at the start, there's so many data points out there that we look at as a team, which we discuss with our manager partners and others, that it's really about bringing all of that together and putting it together as a mosaic and thinking about, well, what does that all mean? And how does that influence how we position the portfolio? So we're never positioned for one event. It's much more using that diversification theme that we have and thinking about where are the individual opportunities within that.
Yeah, good. Well, it's good to know that you are on the money, literally, and in any other sense as well. So I think it's been a really interesting discussion this morning. So thanks very much for that. And I think for advisors and clients watching, as I say, we don't want to know, necessarily don't need to know the workings of it out. You just need to know that when you put that pound in, you've got guys who know what they're doing behind the scenes looking after that money, and I think it's perfectly clear that you are on the ball. So thanks very much for that. Thank you, Jeff. Thank you, George.
Thank you,
Peter.
Thanks, Paul, and for Siri for making an appearance today as well. So that was an extra little added bonus. But thanks also for watching. And as George mentioned, I think 3 times in the podcast today, morning markets. Don't forget that one as well, because you can keep up to date with everything on a daily basis as well. So until the next time on the podcast, it's bye for now.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.